Good
Good
morning,
morning,
ladies and
ladies and
gentlemen,
gentlemen,
and
and
once
once
again,
again,
welcome
welcome
to
to
Small
Small
Case
Case
webinar,
webinar,
which we
which
are
we are
having
having
this
this
Sunday as
Sunday as
always.
always.
And
And
today,
today,
I'm
I'm
super
super
excited,
excited,
and
and
it's my
it's my
pleasure
pleasure
to
to
introduce
introduce
Alok
Alok
Jain,
Jain,
who have
who
been
have
with
been with
us
us
for
for
almost
almost
now
now
7 years.
7 years.
One of
One
our
of our
very
very
early
early
believers,
believers,
early
early
adopters
adopters
at
at
Small
Small
Case.
Case.
Alok
Alok
has
has
been a
been a
founder of
founder of
Weekend
Weekend
Investing
Investing
and a
and a
pioneer
pioneer
in
in
rule-based investing and systematic wealth creation. With over 2.5 decades of experience in Indian stock markets, Alok has helped thousands of investors to achieve consistent returns through his innovative and disciplined investment strategies. Alok holds a BTech from IIT Delhi and Masters in Finance and MBA from University of Maryland, USA, and is a SEBI registered research analyst. Alok set up one of the first national stock exchange memberships in New Delhi and has served institutional, corporate, and retail clients over decades, developing a reputation as an expert in momentum investing, technical trading, and behavioral finance. So today, I'm glad to have Alok on our platform, and we will all have his insights, which have actually transformed wealth creation for investors across India. Let's extend a warm welcome to Alok Jain. Thank you, Alok.
Thank you so much, Rakesh, for this very nice introduction. It's been great to be associated with Small Case since 7 years now, I think. We were the first manager on Small Case,
Yes.
and those days were very different from what we are witnessing today. Small Case we used to be a small company at that time, and today you've grown into a very large market participant, and I'm very happy to be a part of this journey that you've had.
No,
Today, yeah.
yeah, please, sorry, Alok.
So today I would just want to sort of also pay thanks to the platform on which we've had 7 years of a great run also along with you, and thousands of investors have benefited from these products. They have been useful for making people understand how behavior also is a major part of investing, and all these managers coming on one platform, and it is basically a product that was missing from the marketplace. Why should not retail investors under 50 lakhs have great professional manager approach? That really that segment really needed to come, and Small Case has done wonderfully well in that.
No, perfect. Alok, and all kudos to a lot of managers like you who have believed in us. And of course, the technology, which has been our backbone from day one. And even today, we always try to see that what best experience we can give to all our investors. So thanks once again. And uh, looking forward to have this wonderful conversation today around uh, the markets, around what future holds and how you see markets. And I'm sure we will be talking much beyond markets. But just to set the context, Alok, as we all know, last few maybe days or months, we have been seeing a lot of heightened uncertainty, right, in the markets. Nifty, Sensex not going anywhere, maybe for a year or so. But of course, in the last a week or so, we have seen a lot of volatility as well, with small case coming under particular pressure, and headline risks still continue to drive volatility, making, I think, asset allocation decisions more critical than ever, right? So as we were just discussing before this webinar started, that how last 5 6 years have been just one way for equities, and I think in the process, maybe unknowingly, a lot of investors have just not discussed asset allocation, or they have not appreciated asset allocation the way it should be, because it is something which is a all weather thing. But I think this is the time when we strongly feel that asset allocation needs to take their spotlight as a discussion, and that is where we wanted to pick your brains today. And in this dynamic backdrop, Alok, we just thought that it would be a great idea uh, to discuss this. And I'm so happy that you, in fact, are introducing a new small case also around asset allocation as a theme. which will help investors to navigate this challenging and market conditions with a robust and adaptable approach. So, with this context, Alok, I just open the floor to you to share your thoughts, how you think about asset allocation, and how investors should approach this whole piece from your experience.
Sure, Rakesh, I'll do that. Let me just share my screen. I hope the screen is visible to you.
Yeah, Alok, perfect.
Yeah, I would like all readers, all viewers to go through the disclaimer, understand it fully, uh, and then move forward in this video. So, as you rightly said, I mean, we are currently witnessing a significant amount of recency bias in market players. And by market players, I'm not just saying by investors, even fund managers, even the people who are managing funds, managing mutual funds, small cases, whoever they may be. The last 5 years has given them an illusion of high returns, low volatility, perhaps no crisis kind of a situation. And actually, if you extend this argument, then since 2008, perhaps in the last 17 years, barring the 2 months of COVID crisis that we had, there has not been any significant bear market. There has not been any significant crash in the market. So 17 years, our brain, our mind is telling us that markets cannot, you know, go with lower returns in the future. And if you translate that into age of participants, then anybody who, let's say a fund manager comes to the market at the age of perhaps let's say 28, add 17 to that. Nobody under the age of 45 has seen any significant market fall in terms of fund managers, at least. And most investors, 50% or more investors in the market today came post COVID. So they have also not witnessed any fall or any period of major stress. And that, I think, is the sort of context that we need to set, that our recency bias has caused us to think that what we are witnessing right now is something extreme while it is not really. So let's look at some numbers. For instance, this last week, of course, the tariff tantrum has happened and we've lost some ground here. But let me take you, let's say, 5 years back. 5 years back, from let's say August 2020 till now, that's the last 5 years, small cap 250 has grown at 29.4% CAGR. Mid caps 27.8% CAGR. Nifty 500 at nearly 20% CAGR. I mean, these numbers are still mind boggling despite the slowdown that we've had since September last year, despite the 1.5 year period in 21-22 that we had a slowdown. Despite those numbers, the last 5 years look magnificent compared to very long term averages, which for small caps is perhaps near 14-15%. For Nifty, perhaps it is near 12%. So we are still, riding long term averages which are far from the mean. And reversion to the mean is a reality that happens in the market from time to time. And that is what probably we are witnessing in this current phase. If I see some rolling returns, then you are able to see that 3 year rolling returns. I mean, if I see the 10-year rolling returns, it is at 11.8, and 3 years rolling return had reached 26.4 just 2 years back, and which is now coming back to some kind of normalcy. So this also is on the other side telling me that there may be perhaps not too much room to go on the downside also. We are on longer 5 year basis, 7 year basis, we are perhaps above the average, but on a 3 year basis we are probably getting nearer to reality. And maybe there may be some more period to go, but there is not too much to go. That is the sort of feeling, at least, that I have in my own biased opinion. Like you can see here, 5 year is still 16.4%, whereas 10 year we are still at 11.8. So on a 5 year basis, we are still far away. But these are, averages. They really cannot, uh, say what happens tomorrow. Nobody can, in fact. So what we need to understand is that, is our long term story intact? Is India's growth story intact? Are Indian corporates going to be continuously be able to do GDP growth, nominal GDP growth plus, let's say, 4-5% kind of growth? If that has happened in the last 30-40 years, despite whatever events that have come in the Indian marketplace, whether it was GFC, whether it was local election crisis, whether it was .com, all those crises apart, we have been able to grow at a reasonable pace, and there is no reason to believe, at least today, that that path is getting diluted by any chance. It's only that we may be slightly higher than the long term average, and that may get muted over a period of time, but the long term path is not getting deviated from as of today. And that's the sort of silver lining that we always need to keep in our mind when we look at the market, that last 3 years and 5 years don't define the market. We have to see what has happened over a reasonably long period of time, and the instrument that you are using to ride this market vehicle, if whether that product or that instrument is capable of you know finding alpha along the way. So the base market is growing and your product is growing faster than that, and it is able to sort of course correct along the way, so that are able to beat the market going forward. So this sort of brings me into this whole concept of how our journey should be, the investing journey. I've over the last almost 30 years now that I've been in the markets, I have met thousands of investors. What I find is that people are extremely uh, conscious and challenged for returns, and they don't really give enough emphasis to how is that investing journey going. Is it a very pleasurable journey? Is it a happy journey? Or is it a very anxious journey, that I don't know what happens tomorrow? I don't know whether what I bought today, if some situation changes, what will I do? So there is some sort of a anxiety that is there in most people's minds when it comes to their investment. That sort of unsureness or anxiety spills into their personal lives, into their jobs, into their just way of thinking also. And that's what sort of brings me to this question, that can we find this very nice balance, where just like we want to have a personal life balance between job, career, home, our mental peace, so on and so forth, just like that in the markets also, should we come to some sort of a balance where all these uncertainties and challenges that we face, we create a rule based system which can take care of all of this as it goes along. Uh, so many questions that remain unanswered for most of our investing journey is, simplest one of them is, where should I invest within equities? What are my options? Perhaps I should invest in large caps, perhaps mid caps, perhaps small caps. What is doing well right now? People will usually tell you, I choose large caps for safety. They are stable. They will fall less. And when you see the past history, for instance, in GFC, large cap names were falling. Nifty 100 fell 61%, Nifty 50 fell 72%. Uh, Several large cap stocks, blue chip stocks, fell 80 to 90%, which is not unimaginable by market participants today, because they have not seen those kind of periods. Many such periods: November 10, January 18 to March 20, large cap fall. The white line is the large cap fall, the blue line is the small cap fall. Again, October 21 to 22, 20% fall. Again, September 24 to March 20, 17% fall. So there is comfort in large caps, but there is also, immense pain when it happens. And on the flip side, the mid and small caps, once in a while, they will fly like nobody's business. And once that happens, then people who are into large caps, they feel, oh, I missed out. They start feeling the FOMO. the kind of gains that happen. So April 23 to September 24 recently, large cap gaining 62%, small caps gaining 121%. Again, post COVID, large caps gaining 135%, small caps gaining 247%. Post GFC, large caps came back 160%, mid and small caps went up 260%. So huge FOMO happens during those kind of periods, and that is where you want to have a exposure to large and as well as small and mid caps also. The temptation is there. So during bull markets, investors will feel very excited about the lower caps, and during bear markets, investors start to feel the FOMO of not being invested in large cap because small caps will bleed like nobody's business. So all this confusion is there in the minds of people. People will keep hopping from one segment to the other, allocating in a very different way. And also many times, because the small and mid caps attract people perhaps towards very mature kind of trends when they happen, people don't even come to make any money off them. I mean, you make some money and then you lose it all, or perhaps you lose even more of it in the deadly drawdowns. So the question is then how to stay calm when markets are weak, because it is going to happen. Market crashes are a reality. Let's agree to the fact that we've had a very cushioned last 5 years of market play. The last 10 years has not been anywhere close to last 10 years, and last 20 years is nowhere close to last 5 years. If you go back even further, last 30-35 years, you've seen crazy kind of market falls and so on and so forth. So because market shocks will arrive without warning. Geopolitical crisis may happen, a global pandemic as we have seen may happen, a banking crisis can happen, some surprise rate hikes can happen. Markets can change in a heartbeat. You cannot plan so far ahead for the markets that the markets will not put you on the edge. And in this today's fast-paced world, and since 2008, the way the monetary system is evolving, the way the money supply is growing very fast, the way news is traveling through social media, panics are spreading faster, portfolio swings can also happen very wildly. And hence you also need a counterbalance. So counterbalance in today's date, while people are discovering it now, has always been gold, especially for emerging markets, because emerging market currencies are subject to the western world's sort of powers and the way they wish to run the world, and emerging markets are at the receiving end many of times. So we also need a counterweight in our portfolios so that at least the currency risk can largely be taken away, and this unbridled money printing that is happening and money supply that is going up should also reflect somewhere within our holding size. For instance, if let's say all the money printed in the last 5 years, which is almost 60-70% of the dollars that existed before COVID, has gone into some asset class or somewhere, and they've lifted all boats. So this has never happened. Like if you go 10-20 years back, it's never happened that stocks are going up, real estate is going up, gold is going up, art is going up, everything is going up together, because the value of that money and the monetary base itself has expanded so much that it has lifted all the boats in the as the tide has gone. And we've had some fantastic inverse correlation of gold with Indian markets, especially in crisis time. So January 8 to March 09 crisis time, you can see large caps drop 60%, gold is up 37%. Gold is this line in an orange above golden color. November 10 to December 11, large cap, small cap, mid cap all down 30 to 40%. Gold is up 42%. Same. Again, over a longer period also from GFC till November 12, all indices 15 to 44% down. Gold is up 193% during that phase. Again, COVID times, all indices take 2 years to come back from where they were January 18. Gold is up 80% during this period of time. Uh, 24, 25 recently, all indices down 13 to 23%. Gold is up 24% same time period. So lot of instances where markets didn't do well, you're finding that gold as a hedge has done very well, and hence adding that to our portfolio really makes sense. Besides these two major questions, then always people are worried about, will I always be one step behind the markets? Are stocks that are already running, whether I've missed that boat, uh, whether every time I make a choice, it feels like a trade-off between fear and greed. So I bought a stock came down. Now I'm fearful whether my stock will do well or not, and something else is now running. So I move from this stock to that stock, hoping to ride that wave now. But then that one stops and this one starts to go up. Is there a way to grow my wealth without losing sleep? Is there a smarter way to stay invested uh, across all market cycles? When will I know that market is moving into some other cycle? Must I keep shifting my money, chasing the next winner? Can I avoid big drawdowns and not bleed my portfolio, still capture opportunities? How do I prepare for any shock that will come without warning? How do I invest with confidence? So many, these are all sort of our thought processes in terms of we ourselves become our biggest enemy when it comes to investing by complicating a very simple sort of a process. The simple process that could make you reasonable returns which can compound over long periods of time be complicated by overthinking and by over adjusting to the situation. So the thought here is that, is there a simple way to remove all this ambiguity and create the ideal balance where I don't have to worry about the markets? So the components of the ideal balance, because the markets moves differently at different times for different parts of the market, is to invest basically in all three segments of the market, and large cap, mid cap, and small cap, all exposure should be taken, because you don't know, at what time, at what cycle will each of these segments, how they will behave. And of course, as a insurance, as a hedge, we also need gold to be put as a component of this ideal balance. So large cap, mid cap, small cap, the definition of these is given by the regulator. The first 100 stocks in market cap is, they are called large caps. 150 to 101 to 100 250 is mid caps, and 250 to 500 is small caps. So give them exposure of 25% each, and give exposure to gold, a gold ETF for say for simplicity sake, at 25%, and this becomes the universe of ideal balance, and I'll show you how. So what if you could allocate equally to all these indices, and let's say we rebalance it on a monthly basis, keep these exposures somewhere near 25%, and the rebalance of these portfolios. So let's do a test of the historical performance of April 16 to May 25 on this hypothetical indices. So if we were to combine these indices together in the last about 9 years, you can see the red line is large caps. It has gone from 100 to 320. The blue line is small caps. It has gone from 100 to 351. And mid caps have done really well. It has gone from 100 to 492. And gold has gone from 100 to 339. So you may say that, perhaps it is best to invest in mid caps, but that is a last 9 year performance only. So now, if we were to do this portfolio, where we assume that, let's take the large cap index, let's take the mid cap index, let's take the small cap index, give them 25% each, and let's take gold ETF. Where do we stand along with this? So the four that you have seen earlier, and the blue line is the combination now. So now you can see, by combining these four elements of the market, the large, mid, and small cap, along with gold, we may not have achieved the best returns, but it is a much smoother curve over these 9 years. You are able to see how smoothly it has tackled COVID, which is right here. Let me just go there. Uh, okay, yeah. There is a very small drop at COVID times. In 22-23, you are hardly seeing any drop there, and it is currently till May 25 hitting new highs. So if we see the numbers, individual indices did a CAGR of 19% for mid cap, small cap at 14.7, gold at 14.3, large cap at 13.5. But a combination of these indices actually achieved 16.3% over this period. Now, the beauty of the rolling returns CAGR here is that the combination hardly went into any deep 3-year down move. It did go to a negative 6.9% during COVID, but just compare them with others. I mean, small cap was down 3-year rolling return at minus 29%. Large cap down 3-year rolling return almost minus 6%, and mid caps rolling return minus 3 years was almost minus 12%, and the combination is only minus 6%. So you get a much easier product to ride the market volatility. 5-year rolling returns, if we see, the combination has hardly gone below even 10%. Imagine having a portfolio which is made up of indices. I'm not even talking stocks right now, where even on any 5-year basis in the last 9 years, you did not go virtually below double digits. That is the kind of outcome of this. And if you were to see 7 years rolling return, then the combination actually has never seen even 12% in terms of 7-year rolling return. So extremely great dynamics from a returns to volatility perspective. And the magic that you want to see is this, is that while CAGR is a very respectable 16.3 of this index combination, the max drawdown is only 24.8% versus 60.5 of small case, 38.6 of mid caps, and even 28.8 of large caps. What has saved us here is the gold component, which has lost maximum at minus 14.3 in the last 9-year period. So this combination gives you reasonable benefit on the returns perspective and fantastic benefits on the drawdown benefits. And that is why the magic of bringing this together happens. So now let's see what happened during COVID, for instance. Small caps dropped 60.5%, mid caps dropped 38.6%, large caps dropped also 28.8%, and the combination dropped only 24.8%. This is the combination of the last 9 years versus you can see the others, the small cap drawdowns, the mid cap drawdowns, the large cap drawdowns, and that is the combination, the blue line. So you got reasonable uplift in returns while fantastic cut in the volatility. So now it begs the question, what if on basic structure, and this is just indices I'm talking about, we certainly can use stocks to even improve this further. So can we build a momentum strategy using the same logic? What will be that logic? Let's take some stocks from large caps. Let's take some stocks from mid caps. Let's take some stocks from small caps, and let's take the gold ETF and mix them together. Now, what is the benefit of doing this? An index is made up of large number of stocks. So a large cap index like CNX 100 has 100 stocks. Not all 100 stocks are strong at any point. Maybe 20 are strong, 40 are in the middle ground, and 40 are weak. Why should we by de facto invest in weaker stocks? Why not, if we have the ability, choose only stronger stocks within each segment? So we've seen the magic with the indices, but now with the strongest of out of each index, we should get even a better results. And this is where we are introducing this MI all cap gold small case. This is a product that is built on exactly this thesis, and it has been thoroughly tested. And the details of this small case is that it will invest 10 stocks from the large cap space, 10 stocks from the mid cap space, 10 stocks from the small cap space, and one gold ETF, all highly liquid, good quality stocks. And you basically allocate and then rebalance every month on that. Now, let's see where we are able to answer our basic questions that we started with. So we've put the link to this small case in the chat box. You can use that link. So the question that we had in our mind is, where should I invest within equities and how should I stay calm when the markets are weak? So it gives you complete clarity where you are investing. You are equally investing across large, mid, and small caps. And to stay calm during markets, you are always staying with the strength of that index. So what I mean by that is that even when markets are falling, there are always stocks within the index which are falling less and which are perhaps defensive at that time. So let's say Nifty is falling very hard, and all your high or sort of risk on sort of segments, for instance, metals, commodities, autos, banks, they are all falling like this. What happens in that point? Your defensive sectors like FMCG, like pharma, like IT perhaps, will not fall as much, and they will start to show relative strength within that index. And once the market fall is done and the market starts to come back up very strongly, at that point, these stocks, the three that I mentioned of the defensive part, will take a back seat and newer green shoots will emerge, perhaps from the defense sector, perhaps from the sugar sector. And that is what will lead the strength of that index from that point onwards. Like what we have seen recently also is that most of the stocks are down 20 to 40%, but index is hardly down anything from the top because the index is rotating from weakness to strength. And on top of that, the index is also changing every 6 months. The constituents of the index change every 6 months. So the index itself is behaving like a momentum strategy. So always stay with the strength in the index by choosing certain stronger stocks. Diversification across large, mid, and small is fantastic. 30 stocks diversified. You are exiting weakness as soon as it is possible. So you're not staying on with stocks till they are exiting the index, for instance, or they are bleeding like crazy. The best part about momentum investing is that you need to exit weakness very, very quickly and stay with the strength as long as the stock stays with the strength. And of course, you have the protection of gold for the tough times. As I've shown you, in every crisis, you will find that gold as a hedge will come out winning and make sure that your boat remains stable. So just to summarize this product, it is a universe of CNX 100, 10 stocks, mid cap 150 universe, 10 stocks, small cap 250 index, 10 stocks, and the gold ETF. Rotational is the type of momentum. So these stocks continue to rotate every month. It is not that all 30 are going to change. Maybe a few stocks will change every month. Uh, you will have an exposure of 2.5% per stock. So it is not that if in a blue moon one of the stocks hits a really bad patch overnight, it is not that you will lose a whole lot. You are reasonably protected due to diversification. And you basically, once any stock becomes very large, for instance, some stock goes up 5x, 10x, then you will reset those weights every time it hits a 3x kind of a gain. Those kind of security features are there so that it doesn't become lopsided in case one stock or two stocks start to really do well. And of course, you need to keep an outlook of 5 years or more so that an entire business cycle can be seen, the market cycle can fully be uh, uh, exposed to this product as you go along. Capital suggested is 5 lakhs to 50 lakhs for this product. So this is the product. The markets right now, very in the most immediate time, perhaps are not looking so bullish. But I can tell you that nobody is able to time the market. and then not successfully each time. Once or twice in a while you will be able to catch the market bottom or catch the market top, but the best way to make money and to compound is not worry about the market move at all. I've done so many studies to even show that if you started your journey from the top of the market and continued investing gradually, it made no difference where you started. So today's market status has really nothing to do what you will see in your portfolio 5 years or 10 years down the road. So with these words I will take it back to Rakesh, and hopefully you have some questions and I will be able to try those questions, uh, answering them. Thank you, Rakesh.
Sure. Thanks, Alok, for this wonderful presentation. And I think it was a very clarity-led presentation. So one thing which comes to my mind when I saw this presentation and the entire conversation, I think in the world of stock markets, I think one thing which is very super heavily indexed is returns. We just get blind to the risk part of it, and the outcomes when it happens, it's always about the risk. In fact, just on a different note, whenever like people who are not so involved into stock market and all that, the moment I say if you have to come up with one word, stock market के सामने आपका क्या one word होगा? The one word which comes is risk, right? That is the strong narrative in the world about stock markets, right? The moment you say stock market, it's risk. But sadly so, at least people who participate in the stock markets, they are like blindfolded with the only the returns part of it, and everybody is trying to optimizing, as you rightly said, the top and the bottom, which nobody till date have been able to do consistently on a period by period basis. Of course, you can always get lucky, but I think that's just one of those things. So, first of all, thanks for highlighting the risk part of it. Even though at a current market stage where we are, markets are not going anywhere, the idea here is, in fact, how to utilize this time to actually restructure your portfolio when you are getting a reasonably good exits based on your past 5 year journey, right? I'm sure most of the investors would be sitting on good profit and all that. So this could be one of the best time from that point of view as well. Coming back to this strategy, Alok, some questions which coming to my mind as well. That it's an amazing combination of uh, a risk, but you are trying to optimize even returns within that framework, right? By coming up with the best 10 stocks into each uh, allocation. And this is what I believe have been always your framework for so many years about momentum investing. So it will be great, Alok, if you could just deep dive into this 10 stock wala piece, because in my head, I'm playing out that okay, we will be investing in large cap, mid cap, small cap. The first thing which comes to our mind is index. So how you come up with those 10 stocks in this universe of 150 stocks or 100 stocks or 250 stocks as the case may be, and how that reset happen. You touched upon that reset button as well, that at 3x you will be doing a reset. So maybe if you can just help us go through that piece as well.
So, Rakesh, I'll give you first two analogies which will help the viewer understand the concept of momentum also
Yes.
and the concept of risk that we're talking about.
Sure.
So, let's say we are at the race course and 50 horses have started a race. Let's say these 50 horses are representing the constituents of Nifty. And let's say our universe is Nifty only, just for simplicity. We want to pick the 10 best horses out of this. 50 have started to run. After two laps, perhaps there are 10 in the front, perhaps there are 20 in the middle, and there is a pack of 20 which is lagging. Now, after these two rounds, and then let's say there are 8 more rounds to go, who will you bet on? You will basically bet on the front cohort. You have not chosen any one horse, but you're saying if I bet equally on this top front part of the race, it is very likely that at the end of the race, some of them will really do well. Of course, there will be some which will fall back in the next two rounds. So you bet on the top 10. Then let's say two more rounds go by. After five laps, let's say, some of these horses from the top pack have gone into the middle, some from the middle have gone into the last one, and some rookie horse has come from the third to the top one. So now, after these five rounds, I'm saying, okay, initially I bet on those 10, but I think I will remove these two who are not in the top 10 now. And the ones who have come to the top 10, I'm going to include my bets on them now. And that is what is a rebalance. So you are rebalancing your portfolio by choosing to remain with the current strength of the stocks. And you will continue to do this, right? So winners will continue to sort of take more and more lead forward. Laggards will continue to keep lagging behind. And in effect, you have cut the weakness from your selection. Even if after having chosen one, some horse falls back and you may lose some. But in effect, you're not staying with the loss. You're saying, I'm going to cut my losses. This horse is not doing well for me. Let me uh, choose the one that has proven itself. And I'm not guessing. It has come to the top pack and it has proven that you should be betting on me, right? So that is the sort of concept of momentum and rebalance. And the other part is the risk part, where let's say you are running on the road and you fall into a ditch. If it is a 3 feet ditch, you will stand up, you will brush your clothes, you will see there may maybe one or two bruises, and you will then start walking again. If that 3 feet ditch is instead a 30 feet ditch, you are not coming out easily. You would have broken a few bones, your confidence would have been shattered, and you will need external help, which means more capital. Your portfolio is down now in the ditch, and you are not able to come back up on its own. So the idea is to not be in a situation which is a deep bloodletting situation, because to come back from there is near impossible without external help. So you want to nip your losses in the bud. As soon as you figure out that your stocks are taking a beating, you are out of them. And what is the new flavor of strength? You want to be with that. Sectors will continue to go up and down in a more cyclical manner, right? So you have to move with the sectors that are showing you the green shoots right now. After each market cycle, a different market segment leads the market, as you have seen. Sometimes it will be sugar, sometimes paper, sometimes pharmaceutical, sometimes defense stocks. So you need to be with the top few sectors that are performing now. And as and when their journeys will mature, you will get out of them, and by then newer sectors will come through. So this is like a very automated process of sector selection and sector elimination. You don't have to, wreck your brains as to what should I do so that, I can stay ahead. It is automatically happening for you.
Sure. No, perfect. I think this makes sense, Alok. And moving beyond the stocks, where you have allocated 25% each to each market cap segment. So two questions here, Alok. One, was there any strong logic around 25% being equal? That is one. And second thing, how you reset the 25% piece? Even that happens at a monthly level, or the frequency of market cap asset allocation happens at a quarterly level or some other intervals?
So the way this has been designed is, of course, keeping simplicity as a sort of a benchmark
Yeah,
for all the design, and 25% has come from equal allocation besides the gold. We have in the past also worked on strategies where it may be more allocated towards one market segment,
sure.
and we have not found any significant advantage or disadvantage of that. So the best part, we thought, is to keep them equal weighted. In terms of the return to 25%, that happens on a monthly basis, although If somebody wanted, they could customize the portfolio and allow it to run, for some time, and then come to a 25% kind of allocation. But I would prefer just a very simple sort of, and what benefit it does by reverting to equal weights is also to continuously, which is a bit unlike momentum, also to keep chipping off at some profits. Sometimes you find a lot of stocks doing 2x 4x kind of moves, which are the strongest ones. So you, at each rebalance, you are chipping off some of that profit and reverting and averaging out to all your existing holdings. Of course, it will happen on the lower side also. If some stocks is going down, and if it is not getting eliminated, let's say it's mildly down, then you perhaps will add to it also. So these are concepts that we have already tried and tested with so many strategies that are monthly rebalanced, like NNF10 and MI Evergreen, etc. And we found some great outcomes out of it.
Got it. So again, taking a step back, as I just mentioned to all our viewers, that EA strategy is all about managing risk, and we have always been saying this as market practitioners also, that returns are more of an outcome of the risk management, right? That how well you manage risk, and I'm sure markets will be kind enough to reward you with the desired outcomes. So, what could be the risk to this whole risk management strategy, or this risk management tool, or what we may call this new small case? What may go wrong to not work the way it is designed? Like, what are those situations where you feel that this may not work?
See, if if the market goes into a situation which is like 2001 to 2003, or goes into a situation which was like 2010 to 2013, or 2018 to 20, where it becomes extremely dull and there are no trends, and it is languishing, certainly these strategies will also languish. The good part there is that the hedge there is likely to keep your motivation up, and at least have a bright spot in that portfolio. The second part here that I want to mention is that when markets are in those situations, no strategy works, long only strategy. So not trying to single out any particular style of investing, but if the markets are not working, nothing works. And while we are talking about this, I also want to break one myth that goes around is that there are momentum stocks and there are value stocks, and momentum stocks are different. I just want to say that all stocks require momentum for you to make money. Even if you find value, unless momentum enters that stock, you will not make money off it. So momentum is a very integral part of the market, without which nobody makes any money. So don't view momentum as a separate, uh, you know, type of stock or class of stock. Momentum is pervasive. Without it, you get nothing in the market. Whether it is momentum in price, whether it is momentum in earnings, whether it is momentum in margins, it is the backbone of the market. So from that perspective, you are best situated to make sure that as and when markets will start to do well, you will start to benefit out of that. And the other part that can go wrong is that you don't rebalance. You try to buy and sell stocks on your own, like some folks who perhaps will not be waiting for the next rebalance may exit earlier, or perhaps buy more of some stocks. So those kind of tinkerings, if not done, are the best. Just go with the model portfolio. The model portfolio needs to be tracked, and if your portfolio can be as close as model to the model as possible, that is the best and ideal way. The whole idea is you should not be spending more than a few minutes a month to look at this portfolio and to do anything. You should be living your life happily, without fear that this portfolio is going to take care of come what may in the market.
Got it. No, I think your second part resonated with me, and I found that piece more interesting. And at the risk of being philosophical, I think we all are too busy to see how the market is behaving rather than doing some introspection or spending some time with ourselves and uh, observing our own behaviors. I think a lot of people have lost money more by their own behavior than the market behavior,
Absolutely,
right?
absolutely,
So, Alok,
absolutely.
maybe I would like to at least personally get some insights based on your experience that how this behavioral aspect has affected the outcomes, both positively and negatively, and where lot of, I think, importance, of course it is important, but lot of importance has been given to market strategies and all that, but at the end of the day it's our behavior which decides the outcomes. So if you can give some insights on that based on your experience, your journey.
बिल्कुल बिल्कुल बिल्कुल. So I can also talk in Hindi, right?
Yeah, yeah, yeah.
तो एक बड़ी एक ना फेमस एक स्टोरी है पीटर लिंच की. उन्होंने एक फंड चलाया था 79 से 89 तक, शायद 10 या 11 साल. और ही बिकेम द बेस्ट फंड मैनेजर ऑफ द वर्ल्ड. ही गॉट लाइक 28 और 29% CAGR. और मेजेलन फंड, उस फंड का नाम था मेजेलन फंड. और उसके जैसा फंड परफॉर्मेंस नहीं हुआ कभी. तो 12 या 13 साल उन्होंने वो फंड चलाया. और कैन यू बिलीव कि जो एवरेज इन्वेस्टर था उस फंड का, उसने कुछ नहीं कमाया. जब जब सारे इन्वेस्टर्स की एवरेज निकाली गई तो वो 0/0 थी. क्योंकि जब वो फंड किसी साल में 70% बढ़ जाता था तो लोग वहां पर आके खूब सारा इन्वेस्ट करते थे. फिर वो अगले साल 30% गिर जाता था, वहां से वो निकाल लेते थे पैसा. तो इन्वेस्टर का बिहेवियर, जबकि आप ये देखिए इन्वेस्टर कितना लकी था कि वो उसने उस फंड मैनेजर को आइडेंटिफाई किया हुआ था. Despite identifying the best fund manager of the world, because of investors' own behavior, the average investor was not able to make money. तो ऐसा मैंने अपनी जर्नी में भी देखा. जब मैंने 95 96 में ये ब्रोकरेज का काम शुरू किया NSE मेंबर का, तो मैं खुद भी अपनी कुछ इन्वेस्टिंग करनी शुरू करी. तो बहुत मैंने ये कन्वेंशनल इन्वेस्टिंग, वैल्यू इन्वेस्टिंग, ये सब डीमर्जर्स, काफी कुछ ट्राई किया मैंने. और मुझे हमेशा ये दिखा कि भाई मैंने पैसे भी कमाता हूं मैं, फिर वो बेयर रैली आ जाती है, उसमें पैसे चले जाते हैं, फिर बन जाते हैं, फिर चले जाते हैं. तो जब 1 2 3 बार ऐसा हो गया, तब मैंने कहा कि ये क्यों हो रहा है ऐसा. मेरी बिहेवियर की वजह से ही हो रहा है, बट क्यों हो रहा है ऐसा. तो मैंने ये देखा कि डिसीजंस व्हेन यू आर प्रेस्ड अगेंस्ट द वॉल, जब आप बिल्कुल स्ट्रेस होते हो और दिमाग चलना बंद हो जाता है उस समय, इट्स लाइक डियर इन दी हेडलाइट सिंड्रोम. कि भाई एकदम आपको क्रैश हुआ एंड यू आर फ्रोजन, यू आर नॉट एबल टू रिएक्ट. फिर ना आप बेच पाते हो उस समय, ना आप उसको रीशफल कर पाते हो अपने पोर्टफोलियो को. एक तो ये सिंड्रोम बहुत ज्यादा मेरे को दिक्कत हुई इससे. दूसरा ये हुआ कि जो स्टॉक की मैं रिसर्च करूं, जो स्टॉक को मैं बाय करूं, उसके प्रोडक्ट्स, उसकी रिसर्च मेरे को अच्छी लगनी शुरू हो जाए. और कुछ टाइम के बाद मुझे रियलाइज हुआ कि भाई आई एम इन लव विद द स्टॉक. अब चाहे वो नहीं परफॉर्म कर रहा तो भी मुझे अच्छा लग रहा है, वो नीचे जा रहा है तो भी मैं कह रहा हूँ मैं तो और ले लेता हूँ, ये बड़ा अच्छा स्टॉक. तो ये इमोशनल कनेक्ट जो हो जाता है स्टॉक्स के साथ, इसको हमें ब्रेक करना है. कि कैसे हम, वी शुड एक्चुअली नॉट बी इन द मिडल ऑफ थिंग्स, वी शुड बी लाइक यहाँ हम यहाँ पर होने चाहिए और हमारा यहाँ प्रोसेस चल रहा है. हमें यहाँ से वॉच करना है कि ये प्रोसेस ठीक चल रहा है कि नहीं चल रहा. अगर हम उस प्रोसेस के बीच में घुस गए तो हमारा दिमाग जो है ना वो कुछ अजीब से डिसीजन लेने शुरू कर देता है. तो ये सारा धीरे धीरे करते करते 10 15 साल में ये थोड़ी अकल आई कि आई हैव टू स्टेप आउट एंड अलाउ द प्रोसेस टू रन. तो रूल्स बनाए, 4 रूल बनाए. व्हाट टू बाय, व्हेन टू बाय, हाउ मच टू बाय एंड व्हेन टू सेल. कि भाई ये 4 रूल एट ऑल टाइम्स क्रिस्टल क्लियर होने चाहिए. कि भाई किसी भी समय कोई क्रैश हो रहा है, कुछ भी हो रहा है, इफ द रूल्स आर गेटिंग हिट, यू आर आउट. इट इज लाइक अ मिलिट्री, लाइक सर्जिकल स्ट्राइक. एग्जिट मेरा डिसाइडेड है, एग्जिट का अगर प्राइस पॉइंट आ गया, आउट. नो क्वेश्चन अबाउट, कुछ सोचना ही नहीं कि इसकी मैनेजमेंट अच्छी है, इसमें ये हो जाएगा, इसका प्रोडक्ट ही हो जाएगा, फिर ले लेंगे. व्हेन व्हेन द प्रोडक्ट इटसेल्फ विल टेल यू दैट प्लीज कम एंड बाय मी, आई एम शोइंग यू ए गुड ट्रेंड, then we will buy it. So the thesis that changed for me was, instead of me trying to guess which stock will do well, I allowed stocks to tell me that please come and buy me, I am doing well. तो ये माइंडसेट चेंज होने में टाइम लगा, और इट्स अ डिफिकल्ट रीसेट. इट इज नॉट इजी, बट सिंपल है. जैसे कहते हैं ना कि भाई आपको अपना वेट कम करना है, बड़ा इजी है, जाइए 5 किलोमीटर भाग के आ जाइए. तो इजी तो है, लेकिन सिंपल नहीं है करना. तो इसी तरह से ये स्टॉक मार्केट की भी कहानी है कि यू हैव टू train your mind to go one way. I'm not saying momentum is the only way, there are other ways, but you have to be focused towards that style of investing. Create rules, don't get emotional, and continue to compound. मतलब अभी तो हमें 5 साल ऐसे मिले हैं ये वाले, जो पता नहीं पिछले कब आए थे ऐसे 5 साल. तो ये टाइम टू टाइम मार्केट आपकी परसिवियरेंस और पेशेंस को टेस्ट करेगा. हो सकता है अगले 5 साल मे नॉट बी एनीथिंग कंपेयर टू व्हाट वी सॉ इन द लास्ट 5, बट देन हो सकता है कि अब उसके बाद जो 5 साल आए वो ऐसे हों कि जो आज तक नहीं देखे गए. तो एनीथिंग कैन हैपन. आई मीन, इफ यू सी द जैपनीज एग्जाम्पल, उन्होंने 40 साल ऐसे देखे हैं कि मतलब वो 60 से लेके 90 तक, कि उनके 40 टाइम बढ़ गए इंडेक्स. और उसके बाद उन्होंने फिर 30 साल ऐसे देखे हैं जो कभी आज तक नहीं देखे गए. तो मार्केट विल गिव यू ऑल काइंड्स ऑफ सिचुएशंस. हमारा सिस्टम, हमारे रूल्स एंड हमारा बिहेवियर, हमें रेडी होना चाहिए कि भाई वी आर रेडी फॉर एनीथिंग दैट कम्स.
Sure. Oh, interesting. I think, again, two things which I would like to add from this conversation. One thing which you touched upon was very, very important, and which every investor thinks is when to buy. I think this product amazingly takes care of that piece, when to buy. That there is nothing called when to buy. It's just buy in the required framework. Second thing, which again in my experience, as you rightly said, it's a journey, and over a period of time, once realizes that पैसा स्टॉक से नहीं कमाना है, पैसा मार्केट से कमाना है. द मोमेंट when you realize that you don't have to get attached to a particular security, और उसी को आप लेते जा रहे हो, नीचे में एवरेज करते जा रहे हो, एंड द मोमेंट आपका भाव आएगा आप निकल जाओगे. आई डोंट थिंक मार्केट वर्क्स दैट वे. सो द आइडिया शुड बी, एंड the relationship should be with the markets and not with a particular security.
Absolutely.
So that is what I have realized. Of course, even as Alok rightly said, initial part of the journey was not that easy. It was always that you got emotionally attached to those stocks. Uh, there are a couple of questions, maybe one or two questions. I will take it up, Alok, on the chat also, where a gentleman is asking that what about other asset classes like bonds, real estate, commodities, and how do they differ in terms of risk and return? Maybe because right now, from the asset allocation point of view, we have touched only stocks and gold, and there are some more to it. So if you have some view on bonds, real estate, commodities as well.
I have a very strong view on real estate also, and I have been very vocal about it on X and all those things, that there is no taboo on buying real estate like a lot of influencers may say so. I think real estate investing should not be compared to equity investing. I mean, again, we come back to the same situation, same concept, that returns is not everything. If real estate investments are giving you double-digit returns, which are beating inflation, and the kind of sense of security that you will get once, let's say, you bought a house for yourself. Even I'm saying it's not an investment house; it's for yourself. You may get a sense of security, a peace, a sense of peace and calm in your mind that may help you do so much better in the market. Instead of having a portfolio and having only equity, for instance, and if you get a shock of a lifetime, which can happen anytime. I mean, 1987 crash didn't happen after telling anybody. So if all your eggs are in that basket, or most of your eggs are in that basket, that I will grow this basket and then I will buy at some day, I think that is extremely risky. And the other thing is that this leverage business, this home loan business, these are good loans. There are good loans and there are bad loans. I think home loan is a very good loan. you getting money at 7 8%, 9% for 20 years. And if you are capable of making 13, 14, 15, 20% in the markets, why don't you use that opportunity? Of course, with some visibility of earnings that you may have in your jobs or careers or whatever it may be. So as much as you can, expose yourself to this good leverage, and make sure that, because that is a very silent compounding that will happen. You are living in that house also, and it's compounding. A lot of people will say, oh, I don't consider my own house as my investment. Well, if something really goes bad in life, that asset is there. You can always downsize and use that asset. So I strongly believe that as soon as possible, in your middle age 30s, you must try to get into real estate also. And as far as bonds are concerned, I'm personally not very convinced with exposure to bonds, and I'll tell you the reason why. Since the 80s, we've had a global phenomena of reducing interest rates. So, you see all the Western world interest rates have just come down, 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 down last 40 years. And bonds, of being the inverse correlation of interest rates, have always gone up. So yields are coming down, bonds going up. That trend of 40 years has gotten broken at COVID time. And now interest rates have started to rise. If they will continue to rise for a very long period of time, bonds will not do well. So much so that in the last 10 years, people who have bought US treasuries, US bonds have made zero money. And the 60-40 equity bond portfolio used to be a very commonly prescribed portfolio in the whole world. Imagine 40% of your portfolio not doing anything for the last decade. So instead of bonds, I would rather, put money into gold, because even if interest rates were to collapse, gold will still go up. And if interest rates continue to rise, the economies will break down and gold will still go up. So it has become like a de facto uh, trade that you must have, investment that you must have in both cases. But yeah, I mean, some exposure to bonds or fixed income for emergency needs and all those things certainly can be.
Sure. Alok, just a request, if you can just stop this presentation. Yeah. I think there was a similar question from Nishit also on debt instruments. And as you rightly said, exposure to debt can always be there from the point of view of having some fixed income, but not purely from the investments point of view. What gold can give, maybe similar or much better returns than fixed income exposure. So yes, from fixed income point of view, Nishit, definitely debt exposure makes sense, but not from the investments point of view, for sure. There are some good products also, Alok. Some clients are asking on the mutual fund like NPS and all that. Uh, are they also trying to achieve some similar outcomes from the asset allocation point of view and all that? But maybe to that point, in my experience, what I have realized that when people invest in mutual funds and NPS, the one thing they miss out on is one of your, again, rules, how much to invest. I think people just end up investing very little or hardly anything in those kind of instruments for some psychological reasons. I don't know uh, how one should play that how wala piece, how much to invest, because people end up investing in the right products sometimes or most of the times, but they don't end up investing a seizable amount, which will actually make a meaningful difference to their wealth creation or their goals, kind of thing. So how one over a period of time learn the art of sizing uh, once they get the right instrument.
I think uh, it's very different for each individual, because each individual comes with a baggage of what they have learned growing up. Like somebody who may have grown up in a family where equity exposure was zero will come with a very different thought process versus somebody perhaps in your region where they are taught to buy stocks at age 3, and you're talking stocks on the dinner table, and you're talking interest rate on the dinner table, and all this is very natural.
Yeah.
So there is a significant population who are just very fearful of the market. That market is like a casino, and only gamblers go there, and nothing positive is going to come out of here. So this mindset is there because a lot of people want to make quick money. They come and do all kind of leverage bets in futures and options. They lose money and they go back and say that stock market is a bad place. So for people who have lesser exposure to the market, it could be a stepwise exposure. So if you are, let's say, at 0% exposure to the market, you should expose yourself to 10%. Let's say you've chosen three small cases, one mutual fund, whatever may be the mix of the product that you're choosing, and you allocate 10%. Let's say you were at 100 rupees, you've allocated 10 rupees, 90 is still in your safe FD or whatever, wherever you are. What will happen to that 10 rupees? The worst case scenario, that 10 rupees will go to 5 at the end of the year. If we see the last 50 years of history, that also may be difficult, but let's say just for argument's sake, your 10 rupees in the market goes to 5. Your 90 in the FD would have gone to 95.
Sure.
By the end of the year, in the worst of situations, you have not lost capital. So that is a good confidence building measure. Let's say now next year you increase your allocation to 20%. Again, the same thing, that one step at a time, building buffer with each step of allocation. What if the first 10% you got a bumper year, 50% up? Now you are from 100, you are at 110. Now you have a buffer of 10. You can easily take a 20% exposure, and worst case scenario, you will be at 100.
Sure.
So this is a mindset of how to gradually step up in the market, and you should not do it immediately. Somebody gets a windfall from some retirement or something, you should not immediately jump and do it, because your mind is not ready for that volatility. As soon as a 10% fall will come, you will panic because the amount is large. And two things that you should also do is never think of the markets in absolute numbers. A 1 lakh rupee loss may be very big for you, but a 1% or 2% loss is normal in the market, right? Even 10% loss is normal in the market. So when you start thinking in percentage terms, that I've allocated 10 lakhs to the market and I know market can do 20-30% up and down, 3 lakhs gone, I'm not worried because it is 30%. I know in my mind 30-40% drop can happen. But if you are thinking in absolute terms, 3 लाख का नुकसान हो गया, your family में से नहीं भाई withdraw कर लो. So approaching the problem with the right mindset, with the right stepping up gradually, sort of a framework, and with the right products also. That the product that you are investing in should be able to, in a way, self heal itself. Market is hurting. If you are invested in an index, it will recorrect itself every 6 months. With the weakest parts will be taken out, stronger parts will come in. If you are in a small case or a mutual fund, hopefully the manager will, restructure, take out bad stocks, bring in good stocks. The problem happens when people buy 5 or 10 stocks of their own finding and then just sit with it, that I will not sell until these stocks go back to my price, and the market doesn't owe you that it goes back to your price. So those are the sort of situations how you can gradually, one step at a time, achieve that end.
Perfect. Great, Alok. Thanks a lot for all that insights and sharing your journey. So this brings me to the closer of our session today, and I'm sure people will explore the entire strategy what you have just designed, and right now it's available on Smallcase for everybody to take part in. So just to give some con- closing remarks kind of thing. So MI All Cap is basically a multi cap strategy where it's very simple, 25% each to large cap, mid cap, small caps, and gold. This not only achieves the risk management part of it, but it even achieves the returns part of it as a outcome. So it's a very diversified plus a hedged portfolio. And to make it more optimized from the returns point of view, it's there is an inbuilt momentum philosophy built into it, which has been the cornerstone of weekend investing from day one on small case, which is purely rule based, trend following, and data driven. And as rightly mentioned by Alok, the strategy may work at a strategy level, but it may not work at the investor level, and it all depends on your patience and all your behavior, the way you show resilience to the market swings and moods. And of course, small case format makes it accessible and very very easy for all DIY investors. So this is something which I thought to wrap it up. And maybe Alok, before leaving, I would ask maybe one question on behalf of a lot of investors who have actually started their investing journey very recently. So what would be that one piece of advice, especially to beginner investors from your side, based on your uh, 3 decades experience, Alok?
I would say, I mean, if you have arrived at the right product or the right manager or whoever you're following, stop worrying about the markets. I think market worry is the reason why people don't make money from the markets. Don't worry about the markets. Believe in the markets. Believe that over a significant period of time you will make a lot of money from the market. If that belief is there, that positive thought is there, then you will be able to follow all rules, go along with it, and persevere through some tough times also. That will come for sure for everybody. So we need to be sure that we are going to be continuously following what we have started, the journey, that path, and the end result is going to be good. That belief has to be there in your mind.
Perfect. Alok, I don't think this could have been much better than this. And thanks a lot once again for sharing your valuable time and all your insights. So, thank you, everybody. And if you would like to explore this further, please check out MI All Cap Gold on the Small Case platform. The link is already mentioned in the description. And in case if you have any queries, feel free to reach out to us, and we will be more than happy to take it forward from there. Thanks a lot and have a great Sunday. Have a great weekend. Thank you, Alok.
Thank you, Rakesh. Bye bye, everybody.
Yeah.
Bye.
Yeah.